Years of experience to help you manage your portfolios and protect your wealth. Remember to subscribe, like, and share these videos. In tonight's video, I'm going to just go through a general overview of where I think we're in the markets and also what's happening in the background. There's a couple things starting to look very interesting. Let's get into tonight's video. So welcome everyone. Very interesting, boring day, I would have to say. Just a lot of just minor consolidation going on. So let's talk about something I want to cover in tonight's video. And it should be fairly quick to get through this video tonight because there's virtually nothing going on. I set it up as we began this week that most of the focus would be on earnings, and we had like 680 earnings reports today, and nothing was capable of moving really making any impact on any of the market sentiment as we see it right now. So from the standpoint of where market sentiment is, it's neutral at best. It would be my argument from that standpoint. I'm really not focus much on the earnings and the backdrop because they're not really producing what I was hoping to produce. I advertised this week as I thought we would see an amazing that the earnings were going to drive the markets. Well, last week's earnings were driving the markets. This week are just kind of in the backdrop. But I do think ultimately that they'll start to shine a little bit here, as this is probably the biggest week of the earnings season from the amount of numbers that are being released, but not as the impact, at least from the players that are being released. I did something interesting, and a lot of times I'll get my stuff from Zacks and I'll go into their normal earnings reports where you can pull it down. I just actually took their CSV and dropped it into ChatGPT just for fun, and I asked it to give me an analysis of the volatility, big misses, up and down, just a bunch of other stats. It was amazing. So if you want to just get a summary of what's going on in the markets, if you're not using chat, you should be, but I would just go in and find a resource where I had a whole list where I could bring the CSV right in there, and it was somewhat interesting as I look over at the output here. I'm just trying to I thought I had it right on the screen here. But the point of this is there were some big winners and some big losers today, but none of them, like I said, were able to move the markets at all from that standpoint. So I did something, so just as we go forward, I mean, this is like, I started prepping for today, and this is what I came up with. Nothing. I'm going through all the details of today and all that stuff. And I did see your email, by the way, Temple. I think there's anyway. We'll deal with that a little later. So I did just acknowledge that we got that. But there's really virtually nothing going on here. I think it's probably one of the interesting scenarios that I've seen, just from the standpoint we're just setting here about 1% or so off the all-time highs and just trying to figure out what's next. So here's what the only thing that I see, and I covered it in the Substack last night, is kind of the continuing saga of what's going on with the Japanese economy, Japanese yen, and the currency, and what's going on there. Is the only thing. So in tonight's video, I'll also cover we'll go through the dollar. We'll go through a couple other things because, like I said, there's nothing. Our database last night had virtually no output. It was slightly positive, but nothing there. It's just very, very flat. These are difficult times, and there's not even anything interesting to talk about that's happening on the economic front because there's no news to react to. And like I said, the earnings, while there were some big surprises and things that came out of that, there really was from the standpoint of what's going on. I'm just trying to find this one page I thought I had set up, but they're not impacting anything. So who cares about Lyft? Who cares about Uber? All that stuff. Maybe like we'll do a couple more stocks here tonight as well. I'm just looking here. Yeah, okay. Yeah, I'm just looking at some comments. Pretty quiet evening, folks. So let's try to focus in. Let's just go through the technicals. And if I come up with some things by going to the technicals, sometimes something will trigger. So let's just go through the S&P and the typical things that are going on here and see if we can set up at least some expectations. There is, on the yen itself, there was something very interesting, which I'll cover here in a minute. So let's go ahead and cover the S&P 500. So as I've been discussing here for, I don't know, for the last couple of weeks, we are finally setting up, getting a little bit of a consolidation here. I still expect for us to stay above the 40 and the 10 period moving averages. Those are going to be where the support levels are right now. They're at 5186, 5148 is those two numbers. And that's going to be really good support. I was talking about maybe we get a little pullback for a couple of days. We had, for all practical purposes, 4 days up. This is the second day sideways so far. We're also seeing that the volatility is collapsing a little bit here from the standpoint of the market grid is getting a bit more normal from that standpoint. And what we're looking at from the configuration standpoint is we should come back into those numbers. There should be another leg up. We have new Fibonacci targets that came in yesterday. I'll review them again quickly. Is what we're looking at here is 5309 is the next target, which is just short of an all-time new high. And then the second target, Fib target 2, is 5414, which would be a new high. So it's positive that we're seeing the WaveTech Fibonacci tool actually starting to recognize a new pattern here and suggesting that there's some higher prices in the pattern. I think if you turn back a couple of weeks ago, we knew that we were going to get some downside action, and this could end up being just a right shoulder and then a retest of the lows that we made over here at the, let me just bring up these numbers, over here on the 19th of April, which would be that 49.63. There's a couple numbers that I've alerted you to, but I haven't really, I put them out in a Substack newsletter a couple, I think a couple, 2-3 days ago. But we're looking at the downside here, 50.22, 49.63. Those are big numbers. And I've been talking about maybe coming back as far as into the 50 handle, but I think 51.5, 51.20 is going to be about the bottom end of the range of this. And we've got, only thing we have coming out tomorrow is claims and continuing claims. And those are always put out there like they're a big deal. I can only remember in most recent history that there was one day that we had a bit of a surprise. I think it was a negative surprise, and the markets reacted substantially. But I also showed you, I think it was last week sometime, where it's interesting that we had multiple numbers that were exactly the same. I think it was even 212, 212, 212, and the continuing claims are right pretty much the same numbers as well. So it's like these metrics aren't even moving anymore. And I don't know if they're bogus or what to make of them, but they're not moving. They're expected to be 208 tomorrow. I'm sorry, 215 tomorrow. They were 208 last week, but we've seen this 212 number. It'll be interesting if it comes out at 212 claims, and then the continuing claims at 1.774, and they've been dropping. So like one of the things I could point out here that I've been talking to you about is that the Fed continues to be primarily, would appear to me, that they're focused just on the labor markets. And when we start to look at output, we saw definitely some downsizing on the PMIs and some of the other metrics on industrial production. Those things are starting to come in a little bit. So I've been talking about this bifurcation of, you look at labor looks good, but then you look at some of the other measurements of the economy, including GDP that was in the 3 handle, now it's at 1.6, 1.7. And then we did see uptick in the employment numbers. So there's some softening going on here. It doesn't appear to be material. And it's sort of like these things sometimes move in slow motion, that they're gradually moving in a direction and then they blow up and go really fast. And that's typically how the markets trade. But when these metrics that we get from the government, I'm not sure what's really being I would say realistic. One of the things you always have to watch for when you see these reports come out is if they're seasonally adjusted. That means they've been fudged based on they're probably an algorithm now, but they're plugging in previous quarters and making adjustments to smooth it out, because you don't want to see the actual volatility in the numbers, but actually we do, right? But they're smoothing this out all the time. From the standpoint of what's happening here, just finishing off the S&P analysis, like I said, we've got very solid support all the way down here into the 10, 51.60. You see that number, it's a buy. Anytime it comes up, whether it's intraday, I suspect you'll get a good chance at a buy there. I don't think this was an upward ABC and then a roll down into new lows, but it certainly could be. Right now, the evidence is not there for that scenario. And we still have a long signal going in on the S&P. And like I said, we're looking at some of the metrics here. Right now, we're looking at PPM1 is at a 0.23. So that's actually in trend mode. So that just tells you there's about a 60% probability we stay above the 10-period moving average. And just so you know, the first and second derivatives, being forecast that we're going to actually penetrate through the first derivative. When that happens, it tells you that we'll test the value of that derivative, which in the case of PPM1 is a 10. We're going to challenge the 10. If it breaks the second derivative, that typically will tell you it will go to the next level down to the PPM2, something like that. And to the 21-day moving average. So let's go on. Let's take a look at the NASDAQ. Okay, so the NASDAQ is same configuration. I do have the webs up here, so you can see the webbing is starting to get crisscrosses here. So this is a possibility of a bigger consolidation, but this upward 10-period moving average where my cursor is here is very substantial, and it does appear that if we get down to that level, right now it's 17,923. It's rising. Let me give you a rate of change number. It's going up about 35 handles per day, so we're looking at right now up around 17,950, 955 in that range, and that's going to continue to rise over the next several days. So like I said, we got the 4 days up. Even though we didn't make a new high, I'm calling this the 5-day pattern, so we probably get 2 more, maybe as many as 3 more days sideways into this pattern. But we're not getting any big projections here on anything. Even if we look at the PPMs, it doesn't look like we get anywhere until mid next week where we have a possibility of the market starting to improve from that standpoint. So I would say prepare for a lot of boringness, sideways boringness. But there should be a pretty good trading range to be able to trade off of as we go forward here. So just be cognizant that that 10-period moving average is going to be a key level to watch. And for the most part, you're not going to get much satisfaction from anything out of these markets at the moment. We're kind of into that no man's land, especially after we had the Fed, we had unemployment, we had so much come into the market last week. We're still digesting all of those things, including the Fed backing off on QT. All those elements are still out there. So I'm going to jump forward here. We'll do a quick look at the treasuries, but they're doing nothing as well. They're locked in the range. I did notice one thing, and I will cover that, is that we got an outside reversal trade on crude oil. So I'll go through crude. We'll just check through pretty quick here. I'm about 15 minutes in. Yeah, that would be good to know, William. Which petroleum giants are planning on doing hydrogen fuel? That would be interesting. That in itself will crush my favorite stock, Tesla. So okay, let's go ahead and take a look. Let's go ahead and take a quick look at the treasuries, and then we'll move on to crude oil, and then I'll do the yen. So this is daily here. One of the things I talked about in the Substack. Let me get rid of the webs here and clean up this just a little bit. We've definitely got some right along this 40-period moving average on the daily is going to be support. Here's one of those triangles building that I've been telling you about, is where we're likely to trade. We've got a downward sloping 10, upward sloping 40. We're likely going to stay right in this range. Maybe we can go to the next wedge and move a little higher here. But for the most part, the treasuries are going to be stuck between around 4.4% up to maybe 550 up in that level. We finished yesterday at 492, so these are very narrow ranges. There is a pivot right now at 4.52%. Let me get the exact number for you. Yeah, 4.529 is that number. So we're going to be locked in. There's not likely anything that's going to happen. All the news that's going to affect this market is out there already. It does appear, though, and I've been talking about this on Substack, is that we could start to move down toward this 200-day moving average, which would put yields down to 340, and that would be something to see. I said 340, 433. Sorry about that. But that would be a big move from where we are right now. Okay, this is a classic Bob Kendall 3-day trade that is showing up here. It was negative a few minutes ago, but we got an outside bar here on crude oil. And so we made a lower low, higher high than Tuesday. We got a nice move on the upside. We still have this downward slope 10, and I'll just show you, the algos are giving us a potential of one of these V-bottom buy signals that looks like it would be on Friday when this really kicks in. But for this reversal pattern, bring this back up, we've got this reversal. We have to make a higher high, which I believe we possibly have already done. Let me check. Yeah, we've actually made it by a little tick. So we've made the higher high. We just have to close higher. Market has to close above today's close, which would be Wednesday's close at 78.99. So we'll call it at $79 or better. We close there. We should have a possibility of moving up into around 80.5, 80.63 on this pattern. If we close lower, all bets are off. We get more consolidation. Maybe there'll be another setup. But if we go back to the algos, they're all suggesting we're going to get a turn up on PPM 1 and 2 here. That's this indicator where I've got my cursor right here, and then the one below it. These are all set up for the potential for a move up. PPM 1 is still in negative position. It's minus 0.33. So that's going to supply a lot of resistance at 79.95. But all we need is a higher close, and then the next day it looks like that downward pressure will dissipate, and we have a pretty good chance of getting back at least to the 200, which right now is at the $80 level, 80.07, and then the possibility of getting into this mesh here of the moving averages. Doesn't look like a big trade, but I just happened to notice that when I was going through charts before we came up. So I'm going to come back up on screen for a minute because somebody just, I appreciate somebody going, stonks only go up. Appreciate that. And this is something I realized after I got here. I told you it'd be something triggered. So hopefully we get a fair amount of people watching. But here's the deal on this world that we live in. To be in the business of predicting crashes is a really bad business. You can ask Harry Dent, you can ask Peter Schiff, you can ask a whole lot of these guys. And you have to understand, as long as the Federal Reserve exists, as long as the U.S. government exists, guess what? They're going to pump this market. They're out of, if the markets collapse and the entire financial system collapses, like a lot of people are telling you is going to happen, then they lose power. Not going to happen. They're not going to let that happen. The Fed's already showing you that. Even when they took all of the power away, shut down the economy, what did they do? They printed trillions of dollars and then flooded us with money. Said, here you go, little people, you need money, here's all the money, and they pumped up. And what happened from virtually March of 2020 has been straight up. You know, here we are at all-time new highs. And I mentioned in yesterday, I was realizing that back in I think it was around July of 2020, I made the comment that inflation comes back. The best inflation hedge is the S&P 500. And I said, we'll probably see 5,000, 5,100. If you're willing to dig through those old 2020 July videos, you'll find that there. And all I'm telling you is this is why it works like it does. And if you want to get into the big crash and all this stuff is coming down, it's just probably not likely, especially in an election year, especially when there's been some undercover work to find out that Mr. Powell hates Trump. So they're going to do whatever they need to do. We all see this stuff. I'll just say the quiet part out loud. But the reality is that these markets work. We're going to deal with the BlackRocks. We're going to deal with CME. We're going to deal with the New York Stock Exchange. We're going to deal with all these entities. And that's how we make our living. And I've been doing it for a long time. And don't think that they're going to let it go away. They're too big. The conference, I would love to be on that conference call. You could go back to 2020. I would love to hear the comments that were made and behind the scenes with U.S. government, all the governments. I guarantee you there was a giant call on there, and they all discussed what to do during COVID, right? It's all becoming painfully obvious what everything that happened 4 years ago really it was and what it is. But the reality is, I meant to say this on opening comments because this was on my mind. I was realizing that, don't go in, I've called all the big moves down. I've got people hanging around me that would be glad to say I didn't do it if I was lying to you right now. But, the 2008 scenario was a big deal, but literally 1987, and when the big crash happened, all of that stuff, 89, the 2000, all that stuff happened. I actually started a video last night that I went back and I put the indicators. I'm working on a project right now, and I'll just tease you a little bit with it while I'm up on screen, is that we're working on getting the models that are in WaveTech over into TradingView. We think we found a path there. We're actually testing some things right now. But this is what I want. I want you to see that in those periods and go back and see that if there is a big event happening, I can tell you personally, and you can believe me or not believe me, that never got caught in one of these things. And I could bring pictures of my old 930 turbo Porsche that I bought after the 87 crash. But the point of it is that these things have always been very obvious. And if we were about to do that right now, there would be things showing up that would be obvious again. And they're not. Our database is still 61% bullish. We still have a lot of positive rotation going on the short-term database, but the only one that matters is the intermediate. And it's still hanging in there, really acting very resilient. And this is not what we see if things were going to roll over. For example, I'll just go on for one more minute, is that in 2020, in January, February of 2020, before they turned the spigot off, so to speak, we were getting monster sell, just giant selling coming in. And some of, at the time, I was not engaged with a lot of retail folks, and we just basically was a private channel. But all of my institutional clients are going, Bob, why are we getting all these sell signals? We're getting in all kinds of heavy cash. Well, we were at all-time new highs, and we were seeing this roll over. And of course, we now know just a few weeks after that, the markets collapsed. And then on I believe it was March 23rd, we started getting the short-term buys both hands. And in June and July, we started getting monster intermediate trades to come back on. And all of you, most of you, told me I was wrong. The market's going to roll over. The end of the world's coming. And it was I was right. And just from the standpoint that the models picked up those trends that were going to rebound. And, you know, I've just on a little bit of a rant here, but, you know, I saw somebody on, I think it was on X, that they were comparing, are we about to repeat history? And it's always one of these guys that have like 275,000 Twitter followers, X followers, and are we about to recreate 1987? And, you know, it's just those type of analysis. I went in, that's why I went back to 1987 last night, and I looked at what the setup was, and I can tell you 87 in this one, maybe they can bring up a chart pattern that looks familiar, but none of the metrics or anything is what it was before. I know I kind of went into this yesterday, but I just want you to know they're not going to let this thing collapse. Not right now. Not going to happen. And it's just really simple. You watch, Powell and the boys will come up with whatever they want in the June meeting. I believe it's 11th and 12th, and then we've got another meeting in September. And then I think the next meeting is like the following week, I believe, after the election, right? So they're not going to let it happen. I think I'm done. But you know, listen, folks. This has always been, the books have always been cooked. Okay, and they're just going to keep cooking the books, and we're just along for the ride. If we can figure out what the next little float, where the next movement is, that's our game, is to figure out what the matrix is going to do next. We'll put it that way. And that's, I've been arguing this for decades, folks, for more than 4 of them, is that, you know, our job is to figure out where the cash flow is going. If money's coming out of stocks, where's it going? If money's coming out of bonds, where's it going? If money's just coming out of everything, where's that going? We have different asset classes we never had before, which was like, you know, with Bitcoin and some other things come out as well. And I have to say this because I thought about this the other day. It's kind of a silly thought, but what is Bitcoin actually worth? Everything is based on fiat currency, what it's worth, which is kind of funny. we need something to call it. Instead of $61,000, we need to call it something else. So it really is on its own. So I thought that was kind of interesting. Maybe that's the only way we know how to evaluate things is through fiat. So anyway, I think I'm done here. But the point of this is I'm going to go through the yen right now, because the Japanese have been in this scenario for a long time, for 4 decades, and now they're trying to finally unwind QE. Everybody, my buddy Hugh Hendry was my keynote speaker in my 2010 conference, and he was talking about something, and it's still been the case, is everybody wants to turn Japanese, right? Everybody want to be Japanese. So QE, 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 and we played that game. And I think we've unwound some with some of the downsizing and the QT and the raising of yields. And we've certainly been more flexible here in the U.S., but the Japanese have really painted themselves in a corner for decades. So we're going to actually use them as a potential model for how to come out of where everybody wanted to be. And I think that's probably the reason why I've got refocused on the yen. There's some things that could happen here, and I've been throwing out little headlines on Substack once in a while that it's possible that the yen could trigger some major event because they want to protect their currency. That's a whole nother thing. But I'll show you there's some new Fibonacci targets, so I'll try to get out of this loop I'm in. But let's look at the yen and probably just do Bitcoin and call it quits today. And I think that will be about it. But just know the books are cooked. All right. That's why I've been trying to tell you on these earnings reports. I know I thought I got out of the loop. I'm back in. But that's what the earnings are all about, right? The analysts are predicting what the company is going to make, and then you've got the companies giving you forward guidance, and it's all just a game every 3 months to reset the markets, reset market sentiment, and it works. It really works. And that's why when you look at people tell you long-term, the buy and hold guys will tell you, hey, if you just buy and hold, this is what return you're going to get. And I can't argue that, but I think you can, I know you can enhance those returns substantially by actually timing and doing some strategic moves in the markets. So, but my whole point here, what I just said, is it's buy and hold, stick your head in the sand, and see where you are 10 years from now. If the U.S. government's still in place, the Federal Reserve still exists, and BlackRock and all these other entities are still there, it's going to be higher. There's no doubt. It's funny. It was just like a realization. I was talking to an old buddy of mine that I've known for 35 years, and we had a conversation today, and it just triggered me. I thought, yeah, we were talking about this earlier, so this is probably the best thing I could do with our time and sharing this. Anyway, you folks get where I think you get it, So let's go ahead. Let's take a look at the yen. Let's do Bitcoin. I'll come back on maybe some thoughts. We'll look at the some comments that you folks have. But this whole game's cooked, folks. There's no doubt. I love it. I've been pretty good at figuring out what's next, and that's why some reality is always necessary. And anyway, I got to get out of here. So let's go and do the yen. We'll take a quick look at the dollar and then the yen. All right, this is the dollar, the DXY. It's a weekly chart. And I think I'll go out to the monthly here in a minute. But look at really the algos are predicting sideways. But if you recall going back just a year ago even, let's see here, I guess weekly into the end of the year, the Dow was going to collapse. Everything was going to come to an end. Another one of those. And of course, they rebounded right back in here. And it's very interesting because when you look at when the Treasury market was declining so hard, see if I can tie this together. When the Treasuries were going down, you thought, okay, everybody's selling dollars or getting rid of Treasuries, so the dollar's going down, and we were seeing the spike in yield was back in October, right? That was the previous spike. Now we've rallied back. I'm still talking interest rates. We've rallied back, but the dollar effect was you can almost see the ebbs and flow with the markets, because October was a previous high in the dollar, and now we've got a little lower right shoulder on the dollar. But if we look at the algos, it's really just steady. 104, 105, it's just going to stay there, and they're not probably going to drop much below that. We've seen, if you look at the formations and things on the screen, so I have the WaveTech Fibonacci tool, which is projecting these Fibonacci targets. The only one that was valid was the one back in 23, and then we had some targets up in for a peak in October of 23, which was the low of the equity markets, and as well it was the top of yields, and all that hit right in October, and everything flipped, right? What's happened, though, since then is the dollar has come back, yields have come back, but somehow the equity markets have stayed in place as far as in a relative scheme. They haven't been affected through that mechanism like you thought. So there's been a detachment from the relationships that a lot of folks come on there. And I would tell you right now, just more on kind of back on the rant, is be careful of these people that show you all these ratios and how this ratio is the highest ratio it's been in 14 years. That stuff is all BS, because you can make the scaling look like it's dramatic and maybe it means something to somebody, but all you have to do, one of my old mentors said, the prices never lie. Look at the price. It's not going to lie to you. The markets are right, you're wrong, you got to figure out what's next. And so this is the elements that we're looking at here, those detachments. So sometimes it matters, sometimes it doesn't, and there's dynamics that happen. So let's go to the yen and take a look at this. I want to go to the daily chart because this, I saw as of today, and I don't have the indicators up there at the moment, but we got new Fibonacci targets for the yen. Now we printed a 160.21 last week, and we got a big rejection off of there. And I always, excuse me, I always look at those rejections as being significant, and I still believe that rejection off 160 was very significant, and until proven differently, it could end up being the high of the Dow yen or the low of the yen for this particular sequence. And the other thing I told you, I've been telling you about, and I'll blow this up, is we got a volatility bubble. You can see where the market grid just blew out really wide, and now it's contracting, and now we're getting indications of the next movement. I keep telling you that watch for these volatility spikes, then the contraction, then the next move. Now this is a daily chart we're on right now. Let's go to a weekly. And the weekly tells a slightly different story here. Similar but different. Now we have one of the things that is obvious right here. We have the 10-period moving average moving up, so we have a bias. But if you look at the market grid, let me blow this up pretty big. Couple things happened. We got an RTX buy signal last week, signaling that we get 1 to 2 weeks sideways with a bias to the upside, which we're getting right now. We're also getting one of those inside bars. And on a big reversal like what we got, where we also have the outside reversal, the 3-bar trade that I talk about all the time. In fact, I'm working on putting a video together on that trade right now. But when we get that trade, what happens what happens here is we still have upward slope. If we don't close lower, not sure why it's kicking me out there. If we don't close lower on this week, then this will just become a consolidation and we're going to rise above the 10. And I suspect that's exactly what happens, that we'll see the Dow yen continue sideways. But let's draw in a couple of things that I think that will be important to understand here. And so I told you about these big volatilities. So this is a pretty big one. What I suspect is we'll get the market grid to start to contract around these moving averages. I don't think we get the big downward move on the yen. I think we follow this 10-period moving average, the 40. I know I've got a lot of lines here. Let me clean them up. So I think we follow these moving averages here, as far as we probably get along these lines. You've got a decent trend, and we stay above these lines where we'll see market bars come into here. The market grid will also slope into here, and you end up working this range here. Probably the worst case is down to a 21-week moving average. For now, the 10 is going to hold it. So let me clean this up. This, I'm telling you, if you get nothing else out of, hang on one second. If you get nothing else hanging out with me, understand this. These patterns, especially if you have the indicators, what we want to watch for is this two things: the inside bar that we have here, the volatility collapse, and then we will end up with this rising 10-period moving average, and that's going to be what I call your demand line. Right now, that's 152.40. We bounced right back above that. We hardly printed under it right over here in this drastic, reversal that we got the other day. Let me just make that a little more visible. But right here on this reversal is this bar. We stayed right on the 10. We're likely going to do something in here, and the scary part is if we do take out this high, then it's going to be Katie bar the door. Otherwise, this market will completely collapse. You have to realize that this is the Japanese Dow or Japanese yen in inverse, and this will be a very big event if this happens and we start to go above 160. I've told you that 177 is the key number in my view, that if we got up to 177 Dow yen, that would be a disaster for the Japanese. I don't know, anything they do will make it worse. They have painted themselves in a corner, and that's the way it's going to work. As it goes right now, and I'll just keep this pattern up here, we just have this upward trend slope, and we just hope that we don't get above any of these upward levels, around 177. If we stay below that, then there's hope. And this is a very big event. If certain things happen that could trigger a complete rethinking of how money's flowing internationally right now. And so I think I've got enough of this as far as of getting the point across there. So let's do this. I will cover Bitcoin, and then I'll come back on screen and we can chat. If you have any questions on anything I said, please put it up on a line. I'll do a couple questions at the end here. So Bitcoin's has become somewhat of a boring story, but the script that was written going all the way back into March, and this is pre-halving event, is that we're likely to go sideways. I'm going to bring up the algos here. You can see algos are still pointing down. I think at some stage we will challenge the 21-week moving average. That's currently at 58,000, and ultimately we probably get something close to 47, 45,000. And the Bitcoin bulls will argue that. Until we get the break of the 21, we could also stay just right here in this little wedge here. And this is what I've been advertising. I did in Substack the other night, I did do a pattern there where we're likely to stay, and it's really quite simple. We're going to stay below this 10-period moving average. You see we got almost to it this week. The high was 65,513, and that number was 66,415. We came up to that. We got a bit of a rejection going, but we should stay in this range. And next week, if I can get out there, will give us 60, we'll call it 65. Extreme downside will probably be around 57, 56 and a half. And we're just going to continue to consolidate. The part that will get interesting is when this 21 does get broken, which I believe it will, probabilities are pointing that we're going to go down below this level. Then we're looking at all the way down to that 47, 45,000. At that point, it should be a pretty reasonable buy. If we also go back to some of this consolidation period that we had going back into December of last year, if we just look at the general range, we're looking at around 44, 45,000. We probably retrace back to here. And I'm just going to do a but here. But if we don't take out the 21 and we hold it and we start to move back above the 10-period moving average, then it's going to set the tone for a potential another move up. And I won't go through that much detail. I'll save that for the Substack account. So if you're not on Substack, go to kendallreport.com/newsletter, and that will get you there. Yeah, and it may go sideways for 3 or 4 months, but I don't think it's sideways. I think we're already off 23, 25%. If you want to call that, I call that a corrective phase for no doubt. Yeah, and that exactly. Thanks, Bernardo. Yeah, listen, get the Substack seriously. I mean, it's $8 a month. It's not a lot. It keeps me motivated. There's a couple thousand of you getting it, so I appreciate all that. But it's really, I like doing it. I wish I'd get it done earlier. Every night I'm going to get it done early, and I always end up working late. I end up going to bed at 1 o'clock Pacific time, sometimes 1:30. So anyway, that's where we'll go. Let's go. Let me just come back on board here. So anyway, I think, my little rant was probably worth, excuse me, cutting out but just know we're all in the same game here, trying to figure out the cash flow of where these markets are going. You get into these little lulls and quiet zones, and was hoping that the earnings would have more input. Maybe they still will after everybody has come to when it's over with. But this is the big week. I believe this is the climactic week. We still have, I think, another 2 weeks of earnings coming out, but I think this was the big batch that came out from here. And then let's just look at some comments. Yeah, so Henry, way back up, how would that affect the Nikkei? I haven't tied that together, so I'm glad you said that. I will definitely look at that. I would suspect it would not be necessarily good, but I will take a look at that. Appreciate that question. Yeah, I'm just looking at some comments here. Yeah, I'm just looking at Earth Cruiser GT. Yeah. Yeah, listen, I don't think electric cars are the answer, but I do think hydrogen probably is. There's better infrastructure for electric right now than there certainly is for hydrogen. But I think in the end, the Toyota's vision of the world is the better one. And you can see what's going on. You see Rivian, they lost $30,000 for, I think, $32,000 for every car that they sold. And listen, Tesla's not doing any better. If you notice, since the little Elon pump, it's just been drifting back lower. It was up at 198. I think it's printing a 177 handle, I think, now. And, you know, so the EVs have a lot of problems. The biggest one is that nobody wants them, you know. And it's somewhat of a cult. I got involved in hanging around a Twitter/X handle that all this guy does is every minute of his day. He says he has a day job, but it doesn't look like it. I guess the realities is that, you know, Tesla really has a lot of issues. I know everybody's going with robotaxi, all that stuff, and now they're talking about they want to sacrifice some human beings in China to try to figure it out. You know, it's long from being adopted in this country, I would believe. I don't think the regulators are going to be okay with it. And not to mention that the regulators already hate Elon Musk, so that's going to be a bit of a challenge there. So I think that there's a lot of things that are out there that are not necessarily against. I don't have a problem with EVs. It's just like I said, I made a comment, I think, certainly on X. But, you know, in the end, it's going to go, who gets electricity? We have, depending on who you talk to, a 40 to 60-year-old grid system that cannot support these things. And it will take decades to rebuild that to support them. And even if they try to do, you know, this 30-30 thing, it's not going to work. I mean, California, especially, their grid is just absolutely crud, and there's no way to get there. And so the reality is that the EV adoption is lucky to get much over 3 to 4%. I think it's 1.7 total cars right now, and the main reason is because of the part of the reason is because of the grid situation, and not to mention. I actually challenged somebody on X, you'll like this, and I want to race you. I'm going to drive my M4 competition. We're going to race from Scottsdale, Arizona to Billings, Montana. You get to pick the Tesla Plaid, whatever you want, and I will race you there. And I guarantee you I'll just be finishing a full-featured movie long before you even get there, along with dinner at that time. And I think that what's interesting, if I raced them down I-10 to, let's say, from Scottsdale to San Antonio, Texas, it would be a little closer because there's plenty of charging stations and there's super stations. But my point of the race is that it will literally be impossible. You can go on Tesla's website and plot. You have to go on there and plot how you're going to get charged to get there. And it's an interesting challenge. Nobody took me out, by the way. So, you know, I'm willing to put 10 grand on the line to see who won. but it's just not going to happen. So anyway, all right, folks. Yeah, Cannonball Run, exactly. That's exactly right. But yeah. But see, what did Cryptoverse say? It looks like it was funny. Anyway, folks, love hanging out with you folks. I am probably going to be going back at some stage. I'm trying to put it together. We've got a big meeting here at tomorrow discussing how we go forward with the channel. I still have been doing the daily stuff. I think the Substack fills that really well. But I'm probably going to go back to produce videos again. I know I've threatened this before, but they're just a better form of content, and not everybody has 55 minutes and 36 seconds to listen to me babble about stuff. So we're going to get that back into 2020 pandemic style is probably going to be a much better, efficient way. And we'll do some premieres so everybody can chat and all that stuff. And then I'm going to then when I do a live, we'll be able to focus on lives. I'm still going to do lives, but I think there's going to be a big pivot. Still get content that, like I said, Substack to me is the right thing. And I'm working on a couple new additions to the Substack as well. So anyway. Yeah, I agree with the reason why I'm covering the yen and all that. I agree that there's some risk here, but in the end, think about what they did during the pandemic. I saw the funniest thing in the world. I'll never forget this tweet back in 2020, and somebody said, "Oh, we need more money." It said, "Open spreadsheet, add digit, hit save, close spreadsheet." And that's basically what they did. And that's what Powell and others have been on record of saying, well, we can just print money. And I made this comment the other day, I'll say it at the end of this video, is what if nobody paid taxes? They have all the money they need. They just print it, right? Just run things. They can spend all the money they want and then let us keep our money and then spend it and everybody be happy. So, yeah, anyway, yeah, M2.XLF, exactly. That's all you need, and that's what they have. So they can go in there and change that. I mean, think about it. They didn't talk to Congress. They didn't do anything. All of a sudden, the Fed's balance sheet went up, what, 4 or 5 trillion, like immediately? And then we've got the spending side. And I remember chats that we had back in those days is, okay, these guys print the money. The Treasury's got to spend it. So you got to have both of these as partners. And what did they do? They put this idiot Grandma Yellen back, in some kind of capacity. So she knew the game from the inside and outside. She worked at the San Francisco Fed for years and then got to be chair. And it's just, yeah. Like I said, it's a giant scheme. We're all part of it. We just need to figure out how to benefit from the cash flows that are being created and taken away as far as that goes. But right now, they're not going to take the punch bowl away. So anyway, folks, have a great time. Trading tomorrow. Remember, no video tomorrow, but Friday live is still on the sheets for the moment. All right. Have a great evening. We'll talk to you all soon. Give you a call here in a couple minutes. FF, are you in Texas? There's a lot in common with communism, actually. It's about controlling. Subject for another time. Have a great day, everyone. Got it. Definitely an ice salesman. I love it. We should have like an open forum on this. Go get the indicators, kendallreport.com/indicators. Remember, EVs are a WEF program.
Hey everyone, Peter Zine here, coming to you.
Not Peter Zine, no. He's never right. Maybe he's right this time. Good luck trading, everyone. See you Friday. Maybe I'll cover silver in the Substack tonight. Good night.